My name is Hillary Evans, and I'm Vice President of Professional Learning and Public Policy at Philanthropy Southwest. We're very pleased to co-host this teleconference with Westwood Wealth Management. It is truly an unprecedented time where this global pandemic has created volatile financial markets affecting all sectors, including the charitable and nonprofit sectors. We understand that U.S. foundation leaders across the Southwest and beyond are responding to this immediate crisis within your communities, as well as assessing short-term and long-term budgeting and financial planning. Joining us are three Westwood Wealth Management advisors who will be providing a financial market update and forecasting possible economic outcomes ahead. I'm pleased to introduce our distinguished panel of speakers from Westwood. Greg Ballou, Senior Vice President and Private Wealth Advisor, who will be moderating today's discussion. Adrian Helfert, Senior Vice President and Director of Multi-Asset Portfolios. And Matthew Lockridge, Senior Vice President, Co-Director of Equity Portfolios and Senior Portfolio Manager. Just a couple of housekeeping notes. All lines should be muted, and we ask if you are not muted that you please do so to avoid any background noise. And lastly, this teleconference is being recorded. Without further ado, I will turn it over to Greg Ballou.
Thank you so much, Hillary, and welcome to everyone. On behalf of my colleagues, we wish you well. We hope you're doing well. We hope you're staying well. And it sounds like from Hillary's description of our audience today, we've got representation from a wide geographic range of states and communities. However, despite that geographic difference, I'm fairly certain we would all come together on our core mission, and that is to support the communities in which we live and work. And that is even more important today, it appears, than it might have been in the past because of the situation that we're living through right now. So when Hillary asked us to get our thoughts together and to align with the comments she made earlier, we thought we would tackle this telephone call in really two different fashions. One is to provide an update on where we see the markets and the economy now that we're several weeks into the pandemic. And then secondly is to provide some conversation around topics that we're hearing from our own clients in the foundation space about concerns or issues, particularly around their investment portfolios. So I think we've got a great list of topics ahead of us, and I look forward to getting underway. So to tackle the first part of that agenda, we would like to start with Adrian, who's going to give us a few comments about the market in general. And we'll try to keep this a little bit as a conversation as we go on, but I thought it'd be great to get some reference points, and Adrian's going to get us kicked off with that. So Adrian, it's all yours.
Well, thanks for your time today. We have certainly seen all the gyrations of the market. I'm sure we've all been watching here. Just to recap this a bit, the S&P 500 is now down around 15% on the year. That doesn't sound so bad considering that we dipped down to around 30% year to date in mid-March. Risk-free rates, those are rates on U.S. government bonds, have dropped in part from supportive central banking policy and in part from reduced expected economic growth. And the yield on a 2-year government bond went from 1.6% you were earning sometime after Christmas to around 0.2% today. On a 10-year government bond, the real rate, or the rate after inflation, has dropped from around 0.2%, giving you some return on your money after inflation, to now around minus 0.4%, an expected loss of return after inflation. And why I bring this up is, in other words, many investors are fine to park financial assets at a negative real rate of return rather than risk further market gyrations in an upcoming recession. Just looking at some of the other moves on the market update, high quality company bonds broadly added 1.2% of yield compensation for default risk. I like looking at corporate bonds for real world implications of pricing. Essentially, I'm lending to a company and I can calculate the probability of getting it back. So in mid-March, when the S&P 500 was down 30+% year to date, it was over double this amount. In layman's terms, for example, AT&T was compensating me for just under 1% of a chance of default in the next 5 years before all this came about. Today, I'm being compensated for around 9% chance that AT&T defaults in the next 5 years. At the height of this fear episode, that's mid-March, the bonds were compensating me for a 1/3 chance that they were going to default. Now, this obviously wasn't just AT&T. This was a systematic concern and one of market liquidity. we'll talk about later, that can rapidly lead to a turn in fundamental problems for companies. That's why we saw such quick action from the authorities and the regulators. And during this period of volatility, we witnessed central bank action and treasury action or government action, unlike anything that we've seen since the Great Depression, and at breakneck speed. All of those programs we spent months negotiating in the global financial crisis came online within weeks. And then some. The central bank started actually buying agency mortgages to support the housing market, but then announced a program to buy corporate bonds. They had not done that before, and it means we're now taking principal risk on the central bank balance sheet if, or really when, one of these company defaults. It's a loss to the essential taxpayer-funded capitalization of a central bank. That's something we haven't done before. The fiscal programs on the order of $2 trillion already introduced are absolutely necessary and still probably not a big enough boat. Our economy is in the stage of shoot first and ask questions later, and the question being how we're going to repay this. As investors, we are going to be looking both at the now and the later of what is going to happen. The later is what concerns me considerably. With a deficit of 3 to 4 trillion this year and continuing next year, and a national debt level that's going to top 120% of debt to gross domestic product or output, it's likely to keep growth in the future muted. That said, we certainly see opportunities where this could be a secular shift. And I know Matt should talk a fair amount about this, companies and industries that may be able to take advantage of new trends. At a high level, we all still remember 9/11. Those security measures that went into place afterwards are still around. Technology that allows for social distancing and less global supply chain disruption for companies is likely to be a longer term trend. I'll stop there, Greg.
Thanks, Adrian. You know, one question that comes to mind, I think a lot of people, listening to our call here, we think about how the capital markets are reflective or connected with the real economy. And of course, the real economy is taking a hit with high unemployment and all the issues we're all facing. So what do you see needing to unfold to get things, back on track, whatever back on track might mean in the era that we're in right now? And what are some of the events that need to occur to see the economy come back to something you might consider normal?
Good question. And there's a lot of ill transparency, a lot of opacity in this environment. We do think this is very different than the nature of previous economic events that have led to a market correction and subsequent economic resurgence. And we're experiencing something that we've termed the consumption void that is leading our usual economic engine in the United States, consumption, that's 75% contribution to our annual economic output, to grind to a halt. So considering how much, to your question, of that economic impact we'll see is a little bit of a question of how much output contraction does this lead to each quarter? And then much more of how long is this going to last? Currently, we are estimating on unemployment around 15% unemployment in the second quarter. That's from a low of around 3.5% where we started, and higher than any time since the Great Depression. It's like we were driving 100 miles an hour and hit a brick wall. Currently, we are estimating the economic output, or GDP, contracts by 5 to 6% in 2020, thus a recession. But thinking about how we are going to reopen the economy and then the impacts, it's really 3 stages. This is not a global financial crisis. This is a global virus crisis. The first is a fast and comprehensive testing program, where I gain confidence by venturing out into communal areas where others are tested and clear. Several companies are purportedly very near this stage. The second is treatment solutions, and that's going to happen a little further down the road. That's getting the mortality rate to seasonal flu levels, lowering the fear of infection. And we have seen promising results already from pharmaceutical products in the pipeline. The final stage that is unlikely to happen in the very near term is vaccination, so that it's not transmissible to the vaccinated. And you can imagine testing and producing the many hundreds of millions of vaccinations required is going to take the longest. At current, our central expectation is for an activity resumption in the latter part of 2020 as infection rates drop with warmer weather and larger scale testing and treatment options do emerge. Some degree of pent-up demand from consumers, people like you and I that are going to be so excited to actually get back out to a restaurant finally again. And some of the unemployed coming back from furlough will lead to a strong bounce in economic output. But even if we were to see a much faster solution than expected, and just you can imagine the headline Doctors discovered that 3 aspirins every morning leads to immunity. How unlikely. But even in that rosy scenario, we don't see an immediate recovery to previous levels of high economic output, of low unemployment, and by consequence, heightened market valuations. Real economic damage is being done, and a contraction from the longest economic growth cycle in history will naturally lead consumers to tighten their belts regardless, delaying purchases, increasing savings rates. Companies with furloughed employees are likely not to bring them all back at once, choosing instead to take the opportunity to try and make their businesses more efficient from this standpoint. Thanks.
So this will take a while, it sounds like, to work through. It's kind of what I think we're hearing. And which really kind of raises the question, we'll turn to Matt for this, but as a company, let's talk at the corporate level across the public securities universe, at least. Matt works in the equity world. So a company is going 100 miles an hour and hits the brick wall. But before they get there, or once they get through it, there's a term that Jack Welch, CEO of GE, used to use. When a company's got issues, sometimes you have to change the flat while the car's still moving. And I'm wondering, Matt, is that the condition a lot of companies find themselves in, or what are you seeing in your world in the equity universe?
Yeah, no, that's a good question. I think, in terms of equities and how we're managing portfolios, I think the first thing and most important thing is sometimes the hardest thing to do, and that's to take the emotion out of it. Being able to say, yes, this is a scary time, not only because of the financial impact, the job losses, the revenue losses, but the health risks, the human toll that COVID-19 is taking. And so, we as portfolio managers or executives at companies need to be able to put that fear and those daily news items to the side and think clearly about the opportunities ahead. And so, as long-term investors, we're really taking this too shall pass mindset and not being paralyzed by, as I said, the current daily news flow. And so, importantly, during sell-offs like what we saw in February and March, we're seeing prices decline in the stock market at a much greater pace than the value declines that the true business is seeing. The long-term value of a business doesn't change nearly as rapidly as the daily stock prices. So it's important to remember and we remind ourselves of this internally, that the value of any business is the present value of all future cash flows. So it's not just the cash flows today, but importantly, the ones next year and in the future. And really to kind of drive that point home, I was looking at Coca-Cola over the weekend, and we estimate that 98% of the value of that franchise is from cash flows in 2021 and later. So any disruption to this year's cash flow to us will only impact about 2% of the true value of that business. So we can take advantage of the current market dislocations with that type of long-term mindset. And so what are we doing really as portfolio managers? We're trying to sift through how businesses are seeing their fundamentals impacted versus what is implied in the equity markets. And from a portfolio standpoint, what are we doing? We're really doing two things. First, we want to high grade all of our portfolios as best we can. So we have a quality value philosophy, a quality value investment philosophy. So we're trying to buy high quality businesses, but only when they're trading at a discount to what they're truly worth. And so sell-offs like we've seen recently provide us the opportunity to buy shares in very high quality companies that just 3 weeks ago, 4 weeks ago, were too expensive. And so we really want to take this opportunity, all else being equal, to increase the quality of our portfolio, to increase the return on invested capital our portfolio companies have, increase the growth trajectory of the companies we own, and increase exposure to companies with larger moats or larger competitive advantages. The second thing we're doing is really just assessing shifts in exposure and if those make sense. And so at a basic level, it's important to remember that what has helped us the most going into a downturn is not likely what is going to help us coming out. So we want to make sure that we're not just holding on to those companies that have served us well from a downside protection standpoint, but are sifting through some of the carnage in the market, perhaps looking at some of those more economically sensitive areas to really uncover opportunities that will help us as the market starts looking ahead and starts rebounding as the economy strengthens. So let me pass it back to you, Greg, with that.
So it's taking the long view. Obviously, is what we do as investment managers. I'm wondering, however, in the current context, we're in earnings season. So for people in Matt's world, this is time when companies report their first quarter results. And the market's always got some kind of estimate in mind of what those results look like, and then they get compared to reality, and things kind of adjust. And a lot of your comments, Matt, about really the valuation being driven by future revenues or net income, in addition to what's happening currently. Do you see any kind of impact on valuations or companies as a result of this earnings season? We've got a partial quarter, probably excellent results in January, and then it's kind of a meltdown in the last part of the quarter, and then likewise maybe the second quarter of this year. Any impact on your thinking because of what we'll see?
Sure, yeah. So we're really right in the middle of earnings season right now, and companies are reporting their first quarter results, which, to put it bluntly, no one really cares about, because the first quarter was really good. And a lot of companies had positive results, but that doesn't encapsulate much of the impact from COVID-19. So really, it's the forward guidance that is most important, and really the current daily trends that these management teams are seeing. And I would say there's been some commonality as companies report. I would say most CEOs and management teams of public companies are pulling any guidance that they've given for the year. So often early in the year or with their fourth quarter earnings reports, they'll provide full year guidance on what their expectations are for revenue and earnings. And really, most management teams are taking this opportunity to pull that guidance. It's just so uncertain today with what's going on that it frankly just doesn't make sense to give that type of guidance. And I would say additionally, many companies are really taking pages out of their 2008 global financial crisis playbook. So what they did then that's successful, they're really implementing that now. And that would be cost cuts where they can. It would be drawing down on lines of credit to really boost liquidity to make sure that they can see through this crisis to the other side. It's slowing or even just dropping capital expenditures. Anything they can postpone to next year in terms of large spending, large capital projects, they're doing that. And also taking somewhat more of a stakeholder view, a total stakeholder view, and not simply a shareholder view. And what I mean by that is they're really prioritizing less buybacks and dividends, and really focusing more on what they can do for employees, what they can do for the communities that they're in at large, really to lock arms to fight this war that we're in.
It will take a combined effort, no question. Thank you for those comments, Matt. Let's move on to some questions that some of the folks on the call may be confronting within their own office or around their own boardroom tables. And Matt, you mentioned, I'm going to take this to take off on your comment about removing the emotion from the investment process. When we kind of go through an experience like this, and you watch values drop, I think people are kind of hardwired to do something, when problems arise. But in the context of say a typical foundation's investment portfolio, maybe a balanced portfolio, 60-40 equities versus bonds, should people be considering making substantive changes to their overall investment policy right now? Or are there ways that they can, quote, take action without potentially causing more harm than good that could come out of it? Matt, any thoughts on that part of the process when you kind of get away from the company level and into the portfolio level?
Sure. I think at a high level, from an asset allocation standpoint, you want to keep your long-term goals in mind. You don't want to let the daily fluctuations of the equity or debt markets really push you in a direction that doesn't align with your long-term goals. And you really just want to use this type of market volatility for opportunistic rebalances. So if you have a long-term investment horizon with a certain asset allocation mix, I'm confident that if you haven't done anything over the last several months, given the recent market movements, you likely have some assets that are over or under their intended weights. So I think periodic rebalancing, again, using market volatility to your advantage to be opportunistic to rebalance makes sense. But really, there's no need to get too rambunctious with large, asset mix shifts from quarter to quarter. And I think, addition to that, there may be activities on the fringe that could help. And what I mean by that is, given what we've seen in interest rates, perhaps there's a more recent opportunity to use options to provide for additional income if that's what the plan needs. So, simple covered call writing, for example, to add current income while not changing your long-term asset mix. Things like that could be helpful.
Adrian, anything to add to that?
Sure, and it's similar, I think, is I'm a tactical investor and very much in asset allocation. And as a tactical investor, I do look for opportunities to sell things I think underappreciate the risk and buy things that I think overestimate risk in their pricing. Volatile times like now are the best times for those moves that we prepare for. And Matt talked about this heavily, of having a strong understanding of companies and fundamentals. And we're prepared to watch for these times when there are the proverbial babies thrown out with the bathwater, those companies that are pricing near-term risk but not appreciating the long-term cash flows. Second, though, heightened risk, as we see now, does provide a chance for plan participants or plan managers to have greater scrutiny on their liability requirements and the investment policies, and certainly in foundations with longer liabilities, where we can see sharp movements with this heightened volatility, and many years of subdued markets may have dulled our senses on that. If the potential sharp movements during these volatile times will stress the ability to meet liabilities, then that's where tactical adjustments may be required.
So it sounds like from a big picture perspective, stick to your overall investment strategy, rebalance it as appropriate, evaluate tactical opportunities around the edges, and sort of maybe save it for a day where we get a little more certainty around what the outlook ahead of us might look like. Would that be a fair assessment of how to manage a portfolio in this environment?
I think we'd agree, yes.
So at the individual portfolio level, you both mentioned what happens, within a portfolio. Adrian, you mentioned that there is some trading within your multi-asset strategy, and Matt, you mentioned that you perhaps made some changes, going into a crisis versus what you're doing coming out of a crisis. So maybe start with Adrian. What should a foundation manager expect for an individual strategy, a manager of an individual strategy to actually be doing in this environment? Maybe drive into that. What's going on at the portfolio level in your world, Adrian, at this moment?
Sure. Well, key for us is having, Matt talked about this, of having a strong understanding of fundamental profiles and risk. So having a steady hand and enforcing my steady hand around that, so I can, number one, avoid risk where we understand the business and the business model and things may change. And number two, take advantage of opportunities. So you will see us as portfolio managers taking advantage of opportunities with less regard sometimes to non-fundamental based tactical allocation. Secondarily, a recognition or at least an opinion on the potential for a landscape change and the effects it can have on the future opportunity set are something I think you should look for your portfolio manager to observe. I'm looking for asset allocation and what this particular crisis could mean for the future opportunity set is something that as investors we're going to look to take advantage of. Finally, cycles are real. We have just come through the longest cycle in history, a growth cycle, not the greatest, but the longest. And different segments of a market cycle can lead to different opportunity sets. in styles, that's growth versus value, and sectors, that's defensive versus maybe discretionary, and in asset classes, that's your bond versus your equity mix. This is consistently part of our conversation, and we do believe we are in a new phase, catalyzed by the great virus crisis that's caused this consumption void that may change the opportunity set in asset allocation from a historically long growth cycle that we've been through.
Matt, anything to add?
Sure. Yeah. No, I think Adrian said it very well. The only thing I would add is, and he touched on it before, is that this crisis is just so different from what we've seen in the past. And it's really made previous business models that we thought were defensive. It's really turned some of that on its head. So it's just so important to understand these individual companies, the individual drivers of their business, because this downturn, again, is so different than prior recessions. And just one example of that at a high level is when you think about defensive business models like food companies, where previously, up until this crisis, the areas of food that have been very slow growing and very competitive have been the center of the grocery store food items. And the best place to be in the past has been in food service, whether it's universities or hotels or in restaurants, in the convenience store channel. Those have been some of the fastest growing channels within food. But when you think of this crisis, that really has flipped completely. The place you want to be, the place with the highest demand right now, are those center of store, grocery store food items. And some of the biggest areas of weakness are in food service and convenience stores. So really understanding the underlying components or drivers of these individual businesses is just so important right now, because again, this is different than anything we've seen in the past.
Great. Thank you, Matt. Let's turn to maybe a pragmatic question. One of our clients is meeting today, a family foundation, because they want to get the board together and, this is really happening, ironically. They want to get their board together and investigate ways they may fund some projects in their community that are outside their normal spending policy. And, most foundations have a spending policy of some sort. And so the question this particular foundation had kind of raised cash ahead of time and kind of went into the year with a fairly good cash position. But let's assume that a foundation is sort of fully invested going into this meltdown, and maybe they've got enough cash on hand to meet their distribution requests that would have taken place in a typical year, but they do want to ramp up their commitment to the community, their grants to the community. What are some ideas of how to tackle that? I mean, do you sell assets that have gone down the least? Do you bring it down your overall asset level? Do you tackle it with the context for rebalancing? Would y'all have some thoughts as to how to maybe advise? I know you need some specifics for a given foundation to really fully answer that question, but just from a big picture level, any thoughts on how to tackle that issue that some of our foundation friends might find of interest? I might start with you, Adrian.
Sure. It's kind of short. I said earlier around insurance that your liability structure is matched with your asset investment duration, if you will, and looking at the changing liability structure. And many of the foundations and many of you listening, I'm sure will look at either projects that are put off, changing the nature of your liability structure longer, or near-term projects that may be being pulled forward. And to the degree that has a mismatch with your duration of your portfolio, then you have to observe that, and you have to look at the heightened volatility in the environment to assess and ensure that you can meet that liability structure. So to the degree, I would say that I don't think that it's appropriate to sell out of fear, but it is appropriate to ensure that your liability structure is covered.
Matt, any thoughts on that topic?
Yeah, no, I agree with exactly what Adrian said. And I think, it's a day-to-day changing environment, as we all know. And just 3 months ago, forward returns on equities looked pretty low. We had been through a decade, as we discussed, of strong equity returns. So forward expected returns were lower, but just over the last 3 months, that's really changed. So, there's a lot for these asset owners to contemplate when changing portfolio structure, given the expected future returns are also changing dramatically by the day.
Sounds like a topic that foundation managers just need to discuss with their money managers. So it sounds like there's a lot of different ways to tackle that. So one thing we're reading about when you read the financial news, and Adrian, I'll direct this to you, there are a lot of institutions, and Westwood included, that are setting up funds to capitalize on distressed assets, credit in particular. Is that a viable allocation for a foundation? I mean, given the potential lockups, I mean, what does that world look like, Adrian?
Sure. This is dead center in my world, and would say certainly that foundations with longer liability structures generally are the ideal capital allocators to this sector. And there is going to be an extraordinary opportunity in the near and medium term. You might think I'm biased, definitely so. I see this as a great opportunity. As I mentioned, the 33% implied default rate of AT&T from their corporate bonds. There was an opportunity there that was due to the illiquidity rather than the fundamentals. A credit opportunity fund or a distressed credit fund has the potential to provide a balance sheet when daily funds have to sell everything not screwed to the floor, as we saw that March 9th week. That can often be a very near-term opportunity. We're also about to experience a considerably heightened stress, distress, and default cycle. Returns in this for capital can deliver on lower volatility and downside than equity while offering a similar upside. So that is where it can be very attractive. In credit, we often talk about asymmetric return profiles. In the good times, high quality credit bonds might go from $97 to par or $100, with a downside that is $60 in the bad scenario because they're nearing default. That doesn't sound good, but of course it's highly unlikely for those downside scenarios to occur. Those rare times like now where we experience a recession and businesses are going to be in distress or are already in distress, you can turn that equation upside down. You can see opportunities to buy a credit or bond that maybe is at $60 and maybe trades down to recovery or say $50, or it can trade up on realization or liquidity provision up to $100. So that's upside symmetry. And simplistically, the return opportunities like this become asymmetry to the upside.
That's interesting. Another area that I think foundations have sort of taken a deeper dive than many institutions in is in the area of socially responsible investing. And, the environmental, social, and governance screens that get applied to portfolios and even sometimes even more active socially responsible strategies. Matt, within your world, do you see the pandemic having an impact on socially responsible investing overall? Do you see any changes coming down the pike because of kind of what companies are going through right now?
Well, I believe that growth in ESG investing will definitely continue as asset owners can easily gain broad market access and a number of vehicles on a very cost-efficient basis. But you can also specify the types of individual companies or securities that fit with the ESG guidelines that fit their mission or principles. So I definitely think that trend will continue. One interesting phenomena we're hearing just recently in the midst of this COVID-19 crisis, and we're hearing this from some of our consumer-facing companies, consumer products, is that some of the large ESG data providers previously took a tough stance on some of these companies. Thinking of the household products, cleaning supplies, whether it's bleach or the cleaning sprays. The ESG data providers took a tough stance on these companies from an environmental angle because of certain chemicals that were used in their products. And the complaint was that there's this trend towards naturals, and some of the chemicals in their products were considered too harsh. But maybe not so surprisingly, these data providers are actually rethinking that stance and some of these ratings, because these cleaning products are proving to be extremely helpful and effective in combating the spread of germs and disease, which is obviously front of mind right now. So kind of interesting how that is evolving. But to your question, the growth in this area of the market, in my view, will continue.
So that maybe brings up a natural question that was triggered this week when oil prices dropped, or at least the forward contract dropped precipitously. Any changes in the energy industry you would see tied to this as well?
Well, there's definitely a lot of changes going on in the industry, in the energy industry today. We're frankly going up against record supply and a dramatic fall off in demand. So, we are in the middle of a number of energy players reducing output. They're cutting production, which will help the supply side. But the demand numbers are going to be, they're going to be tough for a while, and really you're not going to see things get better until we start getting in our cars again and we start getting on airplanes again, and that demand side of the equation picks up. But that is likely, third quarter, if not fourth quarter of this year. So you're probably going to continue to see negative news headlines on the energy space and oil specifically for some time.
Yeah. Adrian, anything to add before we go to our last question?
No, I think that's perfect.
So I know everyone's given up their lunch, or maybe you're having lunch at your desk. Hopefully you are, but kind of near the end of our time. But I do want to wrap up on one question that, Adrian, you mentioned earlier about the massive stimulus that's being plowed into the U.S. economy. Given the sort of near perpetual lifespan of many foundations and this huge expansion of the deficit and the corrosive effect of inflation over long periods of time, should foundation managers begin thinking about hedges against inflation? Is it too early for that? If not now, what would be a trigger? Any thoughts around that topic?
Definitely. And the long liability structure of foundations makes inflation a consistent concern and always a consideration for hedges against. The second area of, do I believe the U.S. budget deficit should heighten this concern? I'm a little at odds with the consensus on this. Yes, with the $2 trillion plus fiscal package, the deficit will double this year and is likely to stay high next year. This deficit is going to take our national debt from 23 plus trillion today to 29 trillion next year, in a time where economic growth is likely lower than average. Near term, more deficit spending is going to be required to bridge that consumption void. Inflation will rise if we see good economic growth, or if additions to the monetary base, that's the currency in circulation, devalue the US dollar. So to repay our national debt, that's where the consideration comes in, fueled by this heightened deficit spending, medium and longer term. We're either going to have to grow at a really fast pace, which is no expectation, or we're going to have to tighten our belts further as we prepare for higher expected tax rates in the future, or we're going to have to simply print money to pay down our debt. That's an emerging school of thought known as modern monetary theory, or MMT. That usually ends in bad outcomes for emerging market nations, but they're not global reserve currencies as the United States is. I don't think that is going to happen. That's not my central scenario. What all that means is the heightened deficit and debt load will create a natural ballast against resurgent high growth from the fiscal programs. I expect us to emerge from this crisis on a slower than average growth path, the longer term average growth path, for at least the next 5 years. Without this heightened growth, I think it is unlikely to see substantially higher inflation as a concern. Now, you asked about watch points. That's a very good question. Watch points for this would be if our central bankers and politicians start giving serious consideration to printing money to repay our debt load. That's modern monetary theory. Or if we see really resurgent growth from a new technology, or this leads to a next tech boom around things that solve supply chain problems, et cetera. We're not there yet. That said, we are already at a low inflation point, and it is always prudent, especially for, as you mentioned, the near perpetual lifespan of foundations, to have some degree of inflation protection on when it's cheap, which is right now. And you can do this with Treasury inflation protected securities, as well as things like an increased allocation to real assets like real estate and timber and metals. So yes, I think that it is prudent for those when inflation protection is cheap, like right now, to consider those hedges. But I think it's unlikely we're going to see that inflation in the near to medium term.
Matt, anything on that topic from your point of view?
Nothing to add. I think that was great.
Okay. All right. Well, I think that about wraps up our time. Matt or Adrian, any closing comments you would like to make before we close it out?
No, thank you for your time and for listening.
Right. Matt?
Thanks also, and everyone be well.
Great. Well, on behalf of my crowd at Westwood, thank you all for joining us for this session. I, again, concur with Matt's wishes that everyone stays well. And I know we're in a challenging environment. It really calls upon lots of people getting their heads together and figuring out ways to get through many, many issues. And I commend you all for the work that you do. I know you're doing every day to serve your community. So thank you for joining us. Hillary, back to you.
Thank you so much, Greg, and we really appreciate you moderating and want to give a virtual applause to our panel today, Greg Ballou, Adrian Helfert, and Matthew Lockridge, for a very informative and timely financial discussion. While these are volatile and uncertain times, hopefully we can all take the long view here. And join us for future professional learning opportunities and events that we will continue to offer to the grant-making community. A special thank you again to Westwood Wealth Management for co-hosting this discussion today. And we would also like to thank all of you for taking your time to join us. Stay well, and this concludes our teleconference.